You ever look at the market's daily chaos and just wonder, is there a system to all this madness? Well, today, we're going to break down a really powerful method. It's all about using yesterday's price action as a blueprint for today's high probability trades. So let's dive right in. Okay, just take a look at this trade. I mean, wow, it's a near perfect entry. The stop loss is exactly where you'd want it, and boom, it hits the target for a fantastic return. Now, the big question is, was this just a lucky guess, or was it the result of a repeatable, systematic process? That's exactly what we're here to deconstruct. So, believe it or not, the secret lies right here, in the previous day's candle. I know, it seems super simple, right? But this one single candle, it contains a whole narrative. Its open and close prices, they are not just random numbers. They're actually critical levels that can dictate the entire flow for the next trading session. All right, so our first job is to actually understand that story, that narrative. We've got to establish a clear directional bias before we even think about placing a trade. Step one, and this is crucial, it all starts on the daily chart. We're looking for a day that shows its hand, clear, decisive price movement, just like this strong green candle right here. This is our signal. It tells us that for the next day, our bias is bullish, period. From now on, we are only looking for reasons to buy. We're just going to filter out all that sell-side noise. Okay, so once we have our bias locked in, we need to define our battlefield. It's time to mark out the most important price levels from that previous day. This is where the game is played. And you know what's so cool about this? It's how simple it is. There are only two prices that really matter, the open and the close. The daily open, think of that as our pivot point. For a bullish day, we want to buy below it. And the daily close, that's our logical target. It's basically where everyone agreed the price should be yesterday. And this brings us to an absolutely crucial point. This is like a non-negotiable rule of a system. If our bias is bullish, we do not chase price higher. We wait. We patiently wait for it to drop below the open. So why do we do that? Because this area represents a discount. It's like waiting for a sale. It's where the smart money is likely to step in. And honestly, it just gives us a much, much better risk to reward on the trade. Okay, so our bias is set, our key levels are marked on the chart. Now we can zoom into a lower time frame and look for a very specific three-part sequence of events to unfold. This is where the setup really comes together. So, the first piece of the puzzle is something called a liquidity purge. Now, this isn't just random selling, not at all. It's a deliberate, intentional move that's designed to do one thing: trap traders who are on the wrong side of the market. And here's exactly what it looks like in action. Price moves decisively below the daily open. Now, what do you think most people do? They see this as bearish, right? They start panic selling. But for us, for this system, we know a trap is being set. This sell-side liquidity sweep is our signal to pay very close attention. But, and this is key, we do not act yet. We just watch. Okay, so after the trap is sprung, we need confirmation. We need to know that buyers are actually taking control. And that confirmation comes from what we call a break of structure, or BOSS for short. This is literally the market showing its hand. And this chart just illustrates that shift perfectly. See that? After sweeping the lows, the price just rallies aggressively, and it breaks that previous short-term high. This is so much more than just a bounce. This is hard evidence. It's telling us loud and clear that the downward momentum has failed and the buyers are now in command. Now, that aggressive move that causes the break of structure, it often leaves something behind. It leaves a little footprint called a fair value gap. The best way to think of it is as an inefficiency, an imbalance that the market will very likely want to come back and fix. You can see it right here on the chart, that gap left behind by those strong upward candles. That fair value gap, or FVG, it acts like a magnet for price. So our whole game plan is to anticipate that price will pull back into this zone to rebalance itself before it continues higher. And that right there is our precise high probability entry point. All right, so we've identified the complete setup. Now let's talk about execution. How does this build into a complete mechanical plan for actually placing the trade? The execution here is purely systematic. There's no guesswork. We enter the trade as price retraces back into that fair value gap. Our stop loss? It goes safely below the low of that initial liquidity sweep, which makes total sense. And our take profit? Well, that's set at that key high time frame level we identified way back at the beginning, the previous daily close. So, let's put it all together into a simple checklist. the bullish playbook. Number 1, you establish a clear bullish daily bias. 2, you mark the open and the close. 3, you wait patiently for price to trade at a discount below the open. 4, you watch for that liquidity sweep, followed by a break of structure. 5, you identify the fair value gap and enter on a retrace. And finally, number 6, you manage the trade with a stop loss below the sweep low and your take profit at the daily close. See, it's a complete A to Z system. And the real beauty of this whole system is its symmetry. It works both ways. For a bearish setup, you just flip the whole thing on its head. You look for a strong red daily candle, you wait for price to trade above the open to sell at a premium price, you watch for a buy-side liquidity sweep, and you target the previous daily close. The underlying principles are exactly the same. But look, knowing all the steps, that's only half the battle. The true key to making this whole thing work consistently is adopting the right philosophy. So let's be really clear about this. This is not a signal-chasing method. It's not about jumping on every little market wiggle. It is a framework for disciplined execution, and here's why that is so important. When you anchor all of your decisions to a set of non-negotiable rules based on that daily candle, you're doing more than just filtering out noise. You're removing the emotional guesswork, you're removing decision fatigue, and that is the real psychological edge. You're making the market meet your criteria, not the other way around. Ultimately, it all boils down to this one simple idea. Your job is not to predict the future. It's to react to the present. You wait for the market to reveal its intention, to show its hand through that specific sequence of events we've just walked through. Once it does, and only then, do you act. And you act with confidence and precision. So that leaves us with one final thought, one final question for you. The high probability setup, it will appear. The market will show its hand. The only question is, will you be patient enough to see it?